Well, let's switch to commercial real estate now. And according to the latest data from Castle, office occupancy levels came in at just over 50% last week, and it was even lower in the New York City metro area at 43%. But our next guest says that's not the case at his properties. His company just delivered its 8th consecutive quarter of increased leasing numbers, with its Manhattan offices almost 90% occupied. Joining us now for an exclusive interview is Tony Malkin, Chairman and CEO of Empire State Realty Trust, owners of the Empire State Building. Tony, welcome. Good to have you with us. How are you beating the market here with an occupancy rate pressing in on 90% in your properties when the broader numbers are much, much lower in the New York market and nationally for office properties?
Well, Tyler, thanks for having me. Look, we've got continued demand, at least nearly 1 million square feet in 2023. And I think what we've proved quarter after quarter is that it's the flight to quality. And it's flight to quality, by the way, in property and balance sheet, amenities, locations. We did the work and invested over $1 billion in portfolio upgrades with modernization, amenitization, energy efficiency, indoor environmental quality to make our properties future ready. And the results are, as you mentioned, very strong. Empire State Building, our leased percentage increased 720 basis points year over year. 1359 Broadway, 730 basis points year over year. So it's about top of tier, it's about in your price point, and it's about delivering a product and a confidence for the people who want to bring their folks back to the office.
Are these commercial properties that you have? I was looking at a list of your properties, or the biggest ones in New York. It was very interesting, actually, because it was not just office. LinkedIn is your biggest tenant. Am I right on that?
LinkedIn is our largest tenant, and you're right. It's not just office. We have 4 different drivers in our portfolio. Office is only 60% of net operating income. The observatory is next at 25%. Retail is about 10%, and residential, into which we've begun to go, is at 5%. So, look, we're a New York City play, a pure New York City play, and then at the same time, you've got 4 different drivers. Very well capitalized, great balance sheet, modernized and amenitized. And the fact is, the tenants like us for all the things that we bring, and investors have shown they like us a lot as well.
You know, I'm guessing, I don't know whether this is true or not, that if we turn back the clock to this time in 2020, or maybe March, April of 2020, the peak of the pandemic, that you might have been quite nervous about office properties. Were you then, and have you been surprised that your properties and the office market in New York has held up as well as it has?
Well, it's funny because you have some tape on CNBC of me from back in that time and a little time after. And, my view has been very much positive. New York City is an international world capital, number one. Number two, you can't rely on those Castle numbers. Only a few of our buildings even use Castle. The data, to me, that they produce is not really all that relevant. What we see is that collaboration, to be in the workplace, if you look at our tenants and their own comments about what we do and what they do and how that fits together, they want good collaborative spaces for their folks to come back to work. And we have tenants who actually expand with us. Over 2.6 million square feet of expansions since we went public. And post-pandemic, a major component of what those expansions have been is tenants who have said, our people in your buildings show up at a greater percentage than our people in other locations. We want to consolidate and take more space with you.
Yeah, very interesting.